let me get into some housekeeping items. You're going to be getting a green button. It'll pop up periodically, and that's for your continuing education credits. It'll say something like, I hereby certify that I'm present and actively participating in this event. So the system itself will pop up this green button, and you have to just click on it, stating that you are there, present, etc. So if you have any questions or problems with that button, it's usually one of two things. Your internet connection might be slow, and you just simply need to refresh, or the tracking button is probably not available at the moment. So it doesn't happen every minute. It's going to happen periodically, meaning anywhere from 10 to 15 minutes. I already stated there's a Q&A chat box. Feel free to type in questions there anytime. And then during the break, we have 3 speakers. During the break, I'll ask you to kind of submit some questions, and we can kind of go through that chat box. Polling questions are a must. That is separate from that green button. If you want some CPE credits, if you're not interested in CPE and you're just really here to kind of get some updates, that's fine. Then don't worry about participating in the polling questions. But if you do want CPE, you should be participating in the polling questions. Also, for those of you who are COSO implementation members, you have nothing to worry about. For those who are not and you snuck in, typically our producer, CISA, is really good about finding out who's really a COSO implementation member and who is not. It's in LinkedIn. It's a free group within LinkedIn. If you're not a member, you will not get CPE credit. So again, for those of you who want CPE, if you're a member and you're participating through this entire webinar, no worries. If you're here just to get an update and you're not a member, you're not going to get CPE credit. The recording will be available in 2 weeks. Typically, it'll be on Aviva Spectrum website, as well as other social media networks. So, for example, it'll pop up. Usually, it'll pop up in COSO implementation group, etc. So you have some access there when you want to, look at the recording, or some portion of the recording will be there. So let's get into today's presenters. Most of you know me. I'm the CEO and founder of Aviva Spectrum. Been doing internal audit for 11 years. But my guests today are really folks that I wanted to shine in this presentation. So I wanted to come up with something a little different in the marketplace, which is presenting the controls aspects of revenue recognition. So I have a case study. I spoke with the CFO of this company. It's since been purchased, and I asked him permission if I can kind of go through his filing. And I'm going to go through some controls, in particular footnote disclosure controls, and what went wrong in terms of the marketplace's reaction to internal controls, and in particular footnote disclosures on revenue. And then I'm going to cover what the regulators are talking about in terms of revenue recognition controls as well. Larry is going to be kind enough to share with us his perspective. He's a VP of Information Security and IT Compliance at PennyMac. So he'll be covering aspects of IT, not only application controls, but some general controls as well, dealing with the revenue recognition transition. And then Louis Puncel, he's the founder and president of Puncel Consulting Associates, and he is going to focus in on, those 5 infamous steps that everybody keeps talking about to transition to the new revenue recognition standards. Louis is going to take us through a deeper dive in some of the technical aspects and things to consider when you eventually have to adopt the new RevRec standards. So let's get into the agenda. I already mentioned that I'll be covering a lot of the internal controls. I'll cover some overview aspects, what the SEC and the PCOB's point of view is, and then IT control considerations will be given by Larry. And then the basics for adoption are going to be covered by Louis. So I've got about 30, 45 minutes. Larry's got about 30 minutes, and then Louis got about 45 minutes in terms of total speaking time. So you're going to get your full 2 hours. It's going to be jam-packed of information, no doubt whatsoever. But I wanted to cover the basics of what should you really know about the new revenue recognition standard. So the first is, this is the longest time it has taken to come up with a joint effort with the International Accounting Standards Board and FASB. It's the longest written FASB. It's approximately a little over 700 pages. But I wanted to give you the math about how it really works out to get to the 700 pages, because at first glance, a lot of people are already saying, oh, we have to postpone it. I thought, well, wait a minute, let's actually break it down. Okay, so we have about 200 pages, which is the basis of the conclusion. So what's the purpose of creating 200 pages? Is to give readers the overview of why we needed to change the revenue recognition standards. The conforming of amendments is 350 pages. So that's kind of what I call a very technical mapping exercise of past pronouncements into the new pronouncement, and really telling everybody how they've taken into account past revenue guidance materials, mapped it all back, and said, look, we're going to get to the essence of it, to what I would call the actual guidance. And the actual guidance is only 150 pages. That's the real meat of what needs to be read. Okay, so if you really wanted to go to the basis of why they concluded they needed to change to come up with a better revenue rec standards, hey, have at it, read 200 pages. The fact that there's some mapping exercise, this is your SEC reporting manager's job, probably, to figure out what FASB codes or international accounting codes got mapped and how it was done, to what sections. But the actual guidance you're going to have to read, and that's 150 pages, and that gives you your grand total of 700 pages. But yet, a lot of people think it's just too much, right? It's too much to conform. It's too much to actually process. But I know a lot of folks haven't really taken apart that it's only 150 pages long. Now, what problem does it really solve? I've asked this question in different forums, and most people get stuck on this question. It's a good question to ask. In other words, what's the big deal of changing beyond the chair people of the International Accounting Standards and FASB chair? They are very good, articulate, technical accountants. But from a practicality standpoint, the question should be asked, what problems does it solve now that it didn't solve because we really needed a new RevRec standard? Okay, so we know what we had, but we didn't know what we were really missing, that certain industries were asking to create better guidance or materials for. The source of this list really is a very technical writer. He's a columnist for Compliance Week, and it's Steve Top. If you hear him speak, he usually comes to Pasadena. I call it's the CPA prom of Los Angeles. It's what the USC School and the Financial Reporting Institute put together. And he said, look, the problem that this solves is that it's more comprehensive than anything that we've ever had. And this was his short hit list of things that companies would now have better guidance. So contract modifications, changes in estimates in contract life, price, level of effort, deliverables, cost of revenue transactions, service revenue recognition, IP deliverables, loyalty programs, balance sheet presentation, and of course disclosures, which we'll cover in a moment, a big case study that I put together using a real example of what went wrong in doing a short, cheaper version of a disclosure. But this is a more comprehensive list of things that guidance materials out in the marketplace just was not really good, or it just didn't exist altogether. So, quick polling question. We'll get our poll out here. How many of you are going to be disclosing or implementing the new RevRec footnotes in 2016? So I'm going to open it, and it's open for everyone. So it's either yes, no, don't know. And remember, for those of you who want CPE credit, I would strongly suggest you answer these questions as we go along. So yes, no, or I don't know. Let me get into view votes. Great. Oh, my apologies. We're going to have to do that one more time. Yes, no, don't know in terms of who's implementing the new revenue recognition footnotes in 2016. Excellent. So the results are in. 11 of you, or 6%, said yes, you're doing it in 2016. 21% said, or 21 said no, which is 11%, and then 34% of you, or 66 of you, said, you know what, I really don't know, which is fine because I'm assuming some of you may not be in the weeds, so to speak, on the details on that. All right, moving on. In terms of the five-step model, if you've gone to any other webinar or gone to any of these networking events, most people have already heard about the five-step model, and Louis will be covering a lot more in a lot more detail this model. But I wanted to cover it in just a quick overview and think about controls. So the first is identifying contracts with a customer. So in other words, is what's your total population? Not only signed, executed contracts, but all the amendments that go with that and any terms and conditions, right? The second is to identify separate performance obligations in each one. So both legal counsel, the sales folks, and the accounting folks typically need to be on the same page of what is a separate performance obligation, and then determining the right transaction price, and then separating the transaction price when it's appropriate for separate performance obligations. Lastly is to recognize revenue when you have satisfied that performance obligation. Everything sounds so beautiful, so easy, there's nothing to it. So if it's really nothing to it, I wanted to ask a quick polling question about contract identification. So I'll open up another poll. Who's actually started the contract identification process? So I'm opening up that poll for the very first step of the transition to the new RevRec standard. I'm reopening that. All right, so who is on step one, contract identification? Yes, no, I don't know. And then there's even, again, I'm here just for free CPE. We'll leave it open for another 10 seconds. So are you on step one, contract identification? Yes, no, I don't know. So let me broadcast the results. So 14% of you said yes, or 15% said yes, and 29% of you are saying no, and then 12% are don't know. So a lot of delays, I think, especially given the first polling question of where everybody's at on this particular live webinar. It's not too surprising. So in the materials that were offered in the actual accounting standard, there were sections in it that talked about controls in the process. Moreover, when you go into the basis for conclusion, in those pages, it calls out that sometimes delaying revenue for items that were variable, but you have met most of that performance obligation, didn't make sense. So what both accounting standards were saying, look, it may not make sense that why we are telling people to defer revenue, and in most cases we should really rethink certain standards that revenue could actually be recorded earlier. So if that's the case, and I'm going to go through a major case study where revenue recognition was actually allowed to record earlier, but the process of communicating past periods and also informing readers of what future results could entail was the backdrop of the problem. So here are your footnote options. You have what's called a retro version and a modified version of your footnotes. I'm going to put it just in layman's terms, given the wide audience here. Think of retro as you're showing comparative years and you're telling the reader, here's a good before and after, right? But you're giving them a lot more information and it's going to take a lot more work in terms of involving folks to double check not only the footnotes, ticking and tying, etc., but you're also validating those changes on all the entire contract population that you have. Okay, so it's not only taking step one and figuring out all the various steps, but you're going back and forth and saying before and after, before and after. So think of retro as a lot more work, okay, because you're letting the reader know the perspective of periods, past periods, but more importantly, before and after. Modified, to put it in a short version, is giving the reader of here's the current state and here are some changes, and this is the impact of those changes, but it's a very short version of the level of work from retro version of footnotes. So my question to you is, it's a polling question. I'll open this up here. I'm going to pick what footnotes options are you thinking about taking? Is it a retro, modified, or you don't know? Given my very brief kind of overview of the two different choices, retro, modified, I don't know. And okay, so I'm going to keep it open for another 10 seconds. Again, for those of you who really want CPE, I would highly recommend you pay attention right now. Okay, retro, modified, or I don't know. Wonderful. So 6% of you said you're probably going to do retro. I call you the heavy lifters. These are my body building, accountants. Modified, I think this is going to be a vast majority of companies, and we're going to go through a case study of a modified approach using a different accounting standard, but the context, everything is super relevant, and it's supposed to be thought-provoking to this audience. And the rest of you don't know. Let's move this aside and get into some of the meats of this presentation. So here's our case study of wrong footnotes. So how did I become aware of I wouldn't call it incorrect practices. I would call it was just a mistake on the executive team's assumption of the marketplace analysis. Okay. I learned about this company because I was at a speaking engagement. I know the CFO. I've known him for a few years now, and I asked permission if I could use his case as an example for future presentations that I've done. And he said yes, and I'll do a big reveal in terms of what his total thought process was after the fact. But here's the case. We have a company here called Keynote Systems. Now, who and what is Keynote Systems? Well, they're a 9/30 year-end company. They had a revenue recognition, a brand new accounting standard that impacted them during the year of 2011. Okay, but what they do for a living is they provide services to different companies to basically, test the mobility of their apps. Okay, and it's for, is your website mobile ready? When you get to a tablet, etc., if you have reports or other apps, how mobile friendly is it? Okay, so it's basically a service company, but they have contractual arrangements. Here is the face of their profit and loss statement in 2012. Okay, so we're going to go forward in time. And in their footnotes, it says, you know what? I took apart their last footnote in the prior period. I took out their 2011 footnote, and it was in footnote number 2 where they talk about the new accounting guidance. And this is literally word for word. You know, FASB's new accounting guidance, accounting standards update 2009-13, 2009-14, commencing in the first quarter of fiscal year 2011. So the impact happened in Q1 2011. Here's the table that they have, fast forward a year, of just their total revenue, right? Subscription and service revenue, and then system license revenue, okay? Now, it doesn't look too bad in terms of presentation, but you obviously don't see any accounting treatment impact in this footnote, right? So the big thing here is what's not being presented that, let's say, an analyst or someone who's following your stock doesn't see. So what we don't see also is percentages of change. 79 changing to 103 is basically a 30% jump. 103 to 124 is about 20% jump. And I'm using round percentages here just for simplicity, okay? But if you're an analyst and you see this is going up by 30 and this is only going up by 20, there's a 10% delta, right? There's something missing. So we know our story starts in 2011, but we don't know what 2009, 14 and 2009, 13, what the heck is that? Okay, it dealt with software revenue recognition standards that had changed, and it impacted the company in 2011. That's the year that they had to adopt it. And it talks about arrangements and certain elements to those arrangements. And 2013 dealt with different types of deliverables in those revenue arrangements. Okay, why did I pick Keynote? Because this is exactly what some of the meat of the updated revenue recognition standards are asking you to do, is take apart different revenue arrangements, and if you've met those obligations, you get to recognize that revenue. Okay, here's their footnote 4 in 2012, and everything ties out, right? There's just a lot more color, but yet again, what's missing? The changes of that accounting impact. The what if analysis had they not adopted that impact, right? Everything's fine. Let's go back in time, the first year, and this is their fiscal year 2011, footnote 2, and this is their footnote, okay? It's all text. That's the first thing I noticed is the SEC loves tables, and guess who else likes tables? Financial analysts. And here they talk about, you know what, we had this new accounting treatment. We had $7.8 million of revenue that we recognized. And oh, by the way, because of matching principles, we also had to pick up $0.7 million in related costs, okay? Had we not adopted this accounting treatment, we would have looked at $27 million basically spread out, okay? We would not have had any system license. We wouldn't have any maintenance or any support. And by the way, we would have only reported $95 million. So what's the big deal? They didn't really link back to 103 in a table format. They used a lot of text. They did give the reader all the information they needed really to come up with any calculation that they wanted in text format. That's fine. So I wanted to look at their stock, and I said, well, what happened the day before they filed their Ks in each period? And I found out that the day before and after the filing, there's really no big issue. But in aggregate, their stock dropped 32%. 32% stock drop. Of course, there's other elements besides an accounting treatment that causes somebody to drop. But remember, I showed you there was a 10% delta in revenue recognition treatment differences that I think analysts were expecting to see. Okay, here is their stock price graph after the 10K filing in 2011. Okay, there was a downtick basically, and the pop is gone after their adoption. That price went down, and here's the uptick. So analysts, the very first quarter is somewhere right around here, right? Analysts are starting to see, this company's really aggressive. They're getting really profound increases in their Qs, and there was an uptick. Remember, market does react to certain footnote disclosures, and if you're making people work harder to figure out the changes, people can be lazy, okay? And analysts sometimes are very young people too, and they have other companies that they're following, and it could have an impact if you don't give them the nuts and bolts in a table format of how to present it. So my polling question to you is, looking at Keynote systems, what do you think might have been their downfall? Was it, they used a modified footnote and it lacked comparative data? It was bad disclosures all around? Something else happened, or you don't know? So what was the main focus here with Keynote systems in this case study that probably caused them to have a downfall in their stock price? So was it the modified footnote lacked comparative data? It was just bad disclosures all around? Something else happened at the company? Something else was happening in terms of maybe the business segment, etc., or don't know? I'm going to leave it open for 10 seconds. Again, for those of you who are interested in CP, I highly recommend you participate in these polling questions. All right, I'm going to end the poll. 33% of you said it was lacking comparative data when they did have to adopt it in 2011. 15% thought it was just bad disclosures all around, and then something else happened, 8%, and then don't know, 5%. We're going to move on to my conversation with the CFO. I already mentioned that I asked permission to use them as a case study. It is public information, most of this, and in a seminar, we were discussing footnote disclosures, retro versus modified, and he had some very strong opinions that had the company been more thoughtful about doing the retro version of their footnotes, it would have allowed people to really understand certain upticks of the revenue recognition model. And also they would have been giving better risk areas to let people know, look, we might not get that delta of 30% because that was the first year we had a major impact of this new accounting treatment, and we're really looking through in future periods. So in other words, adding a red flag to the marketplace would have been more thought-provoking in terms of footnote disclosures. So that was his opinion, that he would have changed it and done a more thorough job in terms of footnote disclosure requirements. So let's talk about regulators. The ones that love our external auditors, right? They're constantly looking at work papers, the Public Company Accounting Oversight Board, and some of their thoughts. So they came out with an alert on how to audit revenue, and it was late last year. It's Practice Alert 12. It's very meaty. And things that I took away from it is there's a lot of focus on presentation and disclosures and arrangements, contractual arrangements and changes to it. There's a big section about anti-fraud controls that need to be tested, as well as increasing your audit sampling throughout the audit period. So I was very surprised about them reiterating some of the basics in auditing, which is if it's a high-risk area and there are changes or there's additional elements to be considered, you need to increase or decrease, obviously, depending on the risk, your sampling methodology, right? And it talked about lowering your confidence level if you do substantive analytical procedures. In other words, you should really look at a lot of the weeds and level of precision type items for when management has to use judgment. So what were some of the concerns in a couple of reports I'm going to only give two examples. One is dealing with data, and the other is dealing with completeness of controls and some of the arrangements. This is an extract of a PCAOB report on a Big Four CPA firm. It was issued in August 2012. I try not to name names. I don't think it's really that overly appropriate, but you can find it if you'd like. In this case, the firm failed to obtain an understanding of data transfer. Okay, and it was between certain financial applications, and of course, revenue was included in that. And in general, in this statement, the firm failed really good IT general controls. And by the way, when I looked at this issuer, okay, this public company, this registrant, they did not have to restate their debits and credits. Okay, this ding, this major finding, dealt with data not being tested, validated, ensured for accuracy and completeness when it transferred from one system to another, and they got dinged on it as a major failure. Another item is it dealt with a different CPA firm. It dealt with certain revenue arrangements and failing to test the controls over the process that management goes through, especially dealing with multiple arrangements. And that phrase, level of precision, shows up again, and you'll see it in the Audit Alert 12 in a lot of different aspects. Okay, management's thought process when they want to modify a contractual arrangement, how they come to that conclusion, how they price a value on that. If there's any judgment at all, you have to be documenting and testing it and validating it at a certain level of precision. And their standard of care, the PCAOB standard of care, especially in that new audit alert, is very, very high bar. I wanted to cover templates. Most of you understand that we created this group a little over 3 years ago. And we wanted to offer COSO implementation group members, which all of you are. If not, you're not going to get any CPA credit. I already stated in the beginning. I wanted to come up with a template that was very controls related. There's a lot of other templates and case studies about the debits and credits, but I wanted to come up with 5 steps for each, 5 questions for each of the 5 steps to just come up with an aggregate risk score of your internal control structure that hopefully will take you less than 25 minutes. So for only COSO implementation members, especially those of you who are live, I came up with a template that there's a set of instructions. It's 2 tabs only. Your risk score is either going to be low, moderate, or high. Okay, and what the outcome is, you should be going through a series of revenue control questions in the second tab and asking yourself just yes or no basic questions. So in step 1, in the contract identification, it's really saying, do you really know your population of revenue? Do you really know that, including any modifications? And I list out 5 questions, and you answer yes or no. This thing will pre-populate for you in terms of the scoring at the very bottom to get to your ultimate risk score, which is in the first tab. And I put it in a phrase so that if you say more no questions, you have less risk. So for those of you who are, dare I say, cautiously evaluating your transition plan to the new revenue recognition standards, it's good to be cautious. You have more ammunition to wait, especially if you fill out this checklist and you have a lot of no responses, because you know your house is in order. And in order for you to collect the data, to do whatever types of presentations you want to do, retro or modified, you're going to be just fine. Okay? So some of it does get technical, but it's very controls related. An example is question 4. The company only has informal policies and set of procedures to identify when a customer contract is modified with appropriate segregation of duties. So if the answer is no, we have a formal process. We have a formal set of documents. We have great segregation of duties. Guess what? Your control structure for revenue recognition, especially during that transition, is going to be low, especially obviously if you go through all of these questions and there are no. So for those of you who have trouble either filling out checklists or are concerned that the yes or no questions aren't really that comprehensive, I know at Aviva for 2 people, we can show you some of the transition failures and audit evidence required for revenue recognition transition, and go through a priority-driven analysis with those 5 steps in revenue recognition. And we'll cover some of the latest PCAOB internal control standards, including that Audit Alert 12. So for those of you who are interested in having, that are not clients, that want an analysis of your control structure when and if you need to move to the new revenue recognition standards, we call it a control compliance analysis. It's a CCA. Cisa Tahan is our wonderful producer, and she does all of my scheduling, and I only have 2 spots. Normally, you guys have seen the videos, and I have 5 spots. I do not have a lot of time. Most of you who are very good work colleagues, etc., know that I actually was appointed by the SEC to an advisory committee, and I fly out to Washington, D.C. at least quarterly, and I have a lot of reading and independent research on a lot of the topics that we discuss in Washington, D.C. So my availability and my time to help others out who are on live webinars has shortened. So I really only have 2 spots available. Cisa is going to take care of it. If you're interested in going through a control compliance analysis, you have to email her at this live webinar. The recording will not help you. I will not do it for recordings. It's info@avivaspectrum.com, and the subject header should say CCA reservation. I'll mention it again at the end because we have 2 great presenters besides myself today. For those of you who have asked or not gone through the CCA process, there's a 1-hour intake. I benchmark you into various studies and standards, and then you get a custom control compliance analysis report. This is on purpose done so that you can't really see a lot of the detail, but this is a sample of a report, and you can see that it's done by phases. In this case, of the revenue recognition steps, you'll see that there's a risk score. I tie it back to accounting standards or audit treatment, and I come up with the actual issue, and then I come up with a recommendation, etc. So it's pretty in depth. So I'm done with my segment, and we have 2 other wonderful speakers. Larry's going to come up next. I'm going to tee him up in just 1 minute. But since I'm done with my section, I wanted to open up if there's any questions related to some of the materials I presented. Please do so in the Q&A section right now. I'd be happy to take your questions. I either did a killer job or everybody's asleep at this point because no one's got a question in the Q&A chat area. Okay, the question is, how did we get the revenue internal control checklist? I would recommend that you go to avivaspectrum.com / we have a tab that has downloads, and you can grab that template there. When we get to the social media outreach on the video, we'll also mention that COSO implementation members can get it, and we'll mention the site and the link there as well. Excellent. All right, well, let me tee it up to our next presenter, Larry Stewart. He is a VP in the IT audit area of, Larry, where did you come? PennyMac. I just lost Larry here. There he is. Okay, I'm going to make him a presenter. Forgive me while I enable his microphone. All right, Larry works for PennyMac. He's been there a number of years, and he's going to talk about the IT control considerations related to the new revenue recognition standard. So Larry, why don't you kick us off, and I'll add a little bit of color commentary and other fun auditor type comments to your presentation. Larry, I think we need to get your mic on.
Here. Is that better?
Fantastic.
There we go. It helps when you actually turn the mic on. All right. Good morning, everyone. Thank you. I wanted to really kind of touch on the IT controls, and it's kind of a unusual situation when you kind of think of this a standard and saying, well, what are the controls associated with this standard? So I want to kind of walk you through, from my perspective, how I would look at things from an IT perspective. Mostly, we all deal with IT general controls, and this is how I would see that things would be applied. So the standard is as such is recognize revenue to detect the transfer of promised goods or services to customers in the amount that reflects a consideration to which the entity expects to be entitled or exchanged for those goods and services. A lot of words there, but it really is. I think the key is there's detect, and you're trying to, identify. You're trying to understand what you want to, what you're responsible for. So what we're going to do is we're going to actually walk through each one of these 5 steps, and Sonia kind of mentioned this earlier, and what I did here is I said, let's take these 5 steps and let's break them down to what I would consider to be IT considerations. And so as we look at the very first set of boxes here, we have identified the contract with the customer or identify the performance obligations. Well, when I think of this, I'm really looking at this as data classification. So we really want to be able to understand how we classify our data. Now that seems pretty involved, but it's important that we understand that, because if you don't go through this process, then you won't really understand how do you really appropriately program, account for, create your populations, and so forth. The second portion of this is determining the transaction prices, allocation of transactions. Well, this is really your overall your development effort. Now, if you're buying a service, obviously you might not have to worry about this as much, but you still have to go through a whole testing and the change management side of it. So this element, or these 2 boxes, are really about your SDLC and change management. And finally, the last part is what I would consider your oversight. It's your management reporting, your exception processes, and what you really need to just be aware of. And at the end of the day, this is what you're going to be reporting. So I think we have. So those would be all our IT technology control considerations, or IT considerations there. So we have a polling question here, and I don't know if this will this actually come up on the screen here?
Let me get that polling up for you.
Okay.
Yeah, I'm going to put it up right now. Let me get into this. Okay, so the polling question is, of all the possible control considerations, right? I'm going to reopen this.
Right.
Okay. So this is if you had a wish list of, okay, what are the key control considerations, for the transition? It's either the access controls, right, of security, software development lifecycle, IT ops, or D, all of the above. And again, for those of you who are interested in CPE, I highly recommend that you, answer the polling questions. We're going to keep it open for another 10 seconds. Great. So we're going to broadcast the results right now and end it. So about 4 of you said, or 6% said access controls only, 15% software development, 6% said IT ops, and then D, ding, 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 71.6%, all of the above. Okay.
All right.
We got some smart people here, Larry.
Yes. Okay, so yeah, we want to consider everything above. Of course, all the ITGCs are important, but let's kind of walk through each and every one of them and kind of why we would consider maybe access could be the very first one, and this would kind of come into our data classifications area. So if we took the contract information, the pricing information, and we said, well, if we just had to classify data, and just as we classify data for MPPI or PPI information, we would follow that same type of premise. Now, it seems like a kind of a crazy concept a little bit, but we have to be able to bucket everything. Everything has to be kind of in these different buckets, so you can actually create the populations and you can understand how do you manage access. So who is really truly authorized to make changes to these things? So you really want to understand there should be controls around the changing of that contract information, the terms and conditions, the pricing information, who can essentially affect that contract. Obviously, the change management has the change has the changing of the information been approved and authorized. Now, this could be a program change, or this could be kind of like business as usual type of changes, where like configuration. So we always in your systems, you probably are creating contracts, or you're creating a process, or you might have to implement a system change, but you obviously need to be able to prove that there's some kind of change management process in place. You need to make sure that there's an approval authorization over those changes, and obviously what goes with that is the whole testing of it as well. Finally, we're talking about the monitoring of this data. So I would actually, most of this information is going to be classified into, or representative into types of databases. Now, given this information, you may want to put some kind of monitoring capabilities against that database to say, well, it has this table or has these columns, or secure them, or have there been any kind of modifications outside the program. So if somebody is going on the back end and changing this, it's appropriately flagged and identified, and alerts are put forth. So the SDLC piece of this is really looking at our calculations within the system, the forecasting, and I think this is really important because when you look at this, this is going to be the core of this new standard. So how are you actually going to make sure, from a system implementation, from a process and a standard implementation, how are you going to make sure that this is working effectively? Now, we covered, like I said, the classification of the data, but now we're really looking at the changes, the modification. How is it going to be programmed? So what were the considerations? Well, access, again, you got to assume, or you have to make sure that there's segregation of duties for the deployment of the code. That's a given. Even segregation of the inputs, the validation. Just as you would have one person put in a journal entry and they can't approve that same journal entry, you got to make sure there's appropriate segregations of this data. The second part is change management, and as I was saying earlier, this data is this whole system could be something that you're building in house, you're custom coding anything, but you have to be able to really go back and fall back on how you manage the source control, how you test the calculation, how you test the functionality for adherence to this standard. Your use cases, your test cases are going to be important. The approvals of these calculations in the business. So often a development team can just they don't have the insight that a business unit would actually have. So it's very important that you have the appropriate business unit doing the UAT testing to identify, to make sure it's operating effectively and functioning as they see it or as they need it to function. And obviously,
and Larry,
go ahead.
Larry, a quick question on some of the source code and testing of calculations. So some people outsource some of the development of specific apps, or it's a off-the-shelf application. Any recommendations for people who are either outsourcing it to a third-party provider, or it's an off, it's something that is purchased, and they're updating the application based on what the vendor is suggesting is an upgrade?
Right. Well, and that's a great question. Actually, so there's two approaches to that. Let's take the first one, the last one first, and the second one last here. So if it's like a off-the-shelf package, and so you typically are buying that, and then there's just going to be basic configurations that you're going to have to manage. So the the thought process behind that is that you're going to have to make sure that when you're doing your configuration, you really do treat those configuration changes or that implementation or that where you're modifying it as a formal SDLC process, as a change management process. So you would follow that entire life cycle, even though if you're just installing and then you say, okay, you click install and you say I install, and then boom, it's there. But you still have to make sure that you understand how is it tested, how do you validate it, is it working, functioning, and is it producing the way you're expecting it. If you kind of look at an outsourced service provider, so you're actually relying on somebody actually developing this code and they're bringing it across, it still follows a very similar process. It's going to be a little bit more involved. But you would typically, there's a couple things you would probably rely on. One is that they have appropriate change management practices, and that might be where you rely on their SOC 1 or SOC 2 or something to that effect. But your responsibility as a client, you still may have configuration abilities into that software, or the management of or management oversight of those changes. It kind of depends on how each company is configured. So you would still have to apply, and I would urge to apply the strong software development lifecycle. Don't skip the steps and say, well, they're just handling all the software development. Make sure you truly understand how they're testing it, and they're doing their development testing before it gets to you. Make sure that you have to go through that whole UAT process. You have to go through that data validation process if you're converting code or converting data over to a new version or something like that. Because all of those steps are going to be part of when an external comes in. I would imagine I would be asking, saying, all right, well, how did you know that all the data was transferred correctly? How do you know that the coding is, as you said, is what sign-offs, what approvals, what use cases, what test cases did you put sign off on? What's your theory and what's your proof? The before and after of that. Does that answer the question pretty much, you think? Okay.
Perfect. And those SOC reports, you briefly wanted to cover the various types, SOC 1, 2, and 3. Just a quick 1-minute overview.
Yeah, I mean, if you're asking, obviously with all the SOC ones, what you're pretty much, I would be looking for that, that at least a minimum of the SOC 1 there, but everything's going to be laid out for you as a client of a provider, what your UCCs, and they're typically going to cover access controls over that data, and who can manipulate it, because there's no software provider out there that's going to say, oh, okay, well, we're going to manage this all for you, and you have you're going to be just totally reliant on them. They're going to give you access to that environment. So you have to make sure that you have strong access controls. You have to make sure that you have a vested interest in the development here. So I think the SOC 1 or the SOC 2 is really what you're truly looking for, and you can you have to go through this and understand if they have poor change management, then you might need to figure out what you need to do to compensate for that.
Yeah. Thank you.
Okay. So the last piece here is like I said, is just the monitoring of the data application. there's just so many changes that could be made throughout the whole life cycle. So you got to make sure that the transition between, phase to phase, as you're moving it through this standard, through these buckets, so to speak, that it's appropriate and monitored. And in addition to what the jobs are doing, if you have databases pushing, from one database to another database, you want to make sure that all the monitoring is in place. The oversight is, really is, it's like, well, what does management believe that they're doing? This is where accountability comes, in my opinion, here. So the considerations are pretty, you want to make sure that during the SLC process that you come up with that solid use cases. And in those use cases, you're going to really make sure that they test to what you believe is the fundamentals of this new standards. You want to review all reports. You want to test, verify, test again, and verify. I mean, in this particular case, this is going to be your kind of like the core of everything you're going to be doing as far as, validating these reports, even, the aging of the reports, from the start of the process all the way through the end and the final reports. You want to make sure that they all tie out. They represent truly what you expect, because you're taking the standard and you're applying it to a system. So you really have to make sure your end result is what's going to be coming out of that system. So you need to verify all the sources, all the calculations. And finally, this is going to be the big one with all kinds of new system implementation, standard implementation. You can't think of everything, so you're going to have to figure out, well, how do you manage exceptions? How do you report on those? How do you really adhere? Do you have a process, or does the accounting department or the group that's actually reviewing these reports, if they come across let's say a system exception, do they have a solid way of reporting those up to management? What corrective actions do you have to take? Do you have to do something immediate, or is this something that can be wait until the next release? You have to know how you want to report on these, and then keep tracks of them, and then figure out, are these going to be new system changes going forward, or is it a configuration change, or what you need to do to correct it? Or is it something maybe, unfortunately, no system's perfect, and maybe it's something the system cannot fix for you, and it's just going to be a reliance on the business process to understand, here's a standard exception. Go ahead.
And Larry, for those of you who don't know you, I mean, you and I have known each other for a number of years, and Larry, you've seen a lot in your IT audit experience, and obviously known a lot of IT departments in your career. When people have to transition to the new revenue recognition standards, and they're going to need to augment the data for revenue recognition, how advisable, in your opinion, is it to create an IT steering committee specific for this revenue recognition transition? In other words, should there be a steering committee? And if so, if one does get created, are there any best practices you can recommend in creating an IT steering committee?
Yeah, well, I mean, obviously, I would, recommend an IT steering committee, because, it hopefully will be your senior level management team, and the people have, that committee is going to be an oversight. And I think, as far as the creation of it, you want to make sure that you have representation from all the different divisions or departments that are representative inside your company. People that would effectively be impacted by this this new standard. I would actually even go through one, probably create a sub task force out of this, but I would create a process workflow just for this, this standard, and understand, from a control perspective, from both a business control and an IT control perspective, of what are all the controls that are going to be in place to capture and to effectively make sure that it's working correctly. And you could actually look at it like a two-layer approach. You would layer in your business process. You might say, well, this is our business controls that we have for this new standard, but you want to then overlay that with, well, here's the IT implementation of this, and from the way that the data would be coming in, actually flow the data through the IT system, and then sync up both those business processes and those IT controls, from everything from access to change to monitoring of jobs that are pushing data throughout the system, and then know what are the business checks and balances, because in essence that business checks and balances become a somewhat of a compensating control to the IT controls. And you're going to say, so if that IT control fails, say access, you're hoping that the business side will be a good compensating control of that reconciliation or whatever. So, and then you would walk through that process.
Yes, I agree with you. I mean, it seems like IT steering committee or subcommittee within the revenue recognition, let's say, task force of a company should be done. And number two, I really took away from your comment a flow chart analysis. In other words, highlight some of those core changes because of the new revenue recognition standard. So do a business process flowchart and show at a high level at least where those changes in terms of data manipulation, et cetera, in key reports, which actually leads to our other question that we received, which is how often do the new reports have to be tested? So that's one. And then the second, as a follow-up to that question, is how often do you need to verify source data and verify the calculations?
Okay. Well, the testing of reports should be done. Well, there's two levels of testing I would always look. So if you're obviously coming up with a brand new report, you want to be testing that. So anything new, obviously, is going to be tested fully. But if you're putting in let's say you're making an entire functional change within the application itself that would directly impact the function of the application, but the outputs there, then I would actually go through a regression test, and you're testing all those reports, all the critical reports. So obviously, one of the things that we always try to do is we try to identify what are the critical reports that you absolutely want to test. You want to make sure that they're correct. You would use that same methodology of making sure that you're testing for everything that is critical, and I would do that with every release that would be functionally based. So anything that you're making a code-based change that that could affect that report. So if you're making a UI change or just a backend configuration change, you might not need to test that report. But if you're actually changing the functionality or a workflow or something to that effect that could manipulate that data and the output of that data, I would review your reports and make sure that they're correct. And then the second question was?
Oh, the second was dealing with how often do you need to verify source data and verify that calculation? So what's the frequency of verifying that source data and calculations?
Well, that should be almost a inherent to your process. Hopefully you got good source code repository. So let's say you don't. Okay, let's go worst case scenario. So if you don't have a good source code repository, then you really should be going through some kind of additional code review. So every time you're going through your system development lifecycle, there is a constant code review that somebody independently is looking at this and saying, okay, well, this is what was pulled out, this is what's being modified, that's all that's being modified. There's some great tools, simple tools that can actually do that for you on the fly. It's not a big effort, but it's almost with every kind of code release you should be going through some kind of validation, at least of the sections. You don't have to, not your entire code base, but the sections are being changed. Okay. So what I did here is I kind of created a simple use case I came across here. It's about a large DC base 501c. It has federal contracts. It has a fiscal year of June 30th. There's contracts that contain multiple options or optional years the first year after the first year. The contract contains multiple revenue streams, reimbursements, fixed fees, performance based. And what I wanted to do is kind of like say, well, if we were to just kind of take this use case as a high level, bullet points, how would we apply, or what would we be, applying these controls to from an IT perspective? So, we would obviously want to identify the classification of data. So, as I look at this, so what are all the important pieces here? I mean, so you got dates, you need to understand, there's going to be flags here for multiple optional years. So you have to understand those flags, your revenue stream. So that's probably a flag determination. There's a cost for reimbursement. Here's your fees. Here's your performance base. Those things there are all going to be, things that you would want to somehow classify. And you could do this in an index or some kind of table version, or just, something that you want to identify as important information. But really, I think a lot of it's going to be driven around your date fields and then just these flag indicators. The amounts themselves aren't going to be as critical, because obviously those are going to be changing, but you will want to know just the flag and the indicators. Remember, this is a standard that are going to be applied, so these standards have to be, kind of like turned on and off type of thing. So you have to be able to identify them. The second is what does the system have to calculate? What are the appropriate UAT sign-offs in the business unit for accounting? Well, obviously we want to look at the outputs here and the cost of reimbursement, the base of participation. The base of percentage of completion, the performance, the base of judgment. So those are the things that when we're thinking of the system calculations, these are the elements that we really want to be able to have a good controls from a system perspective over the calculations. And finally, the oversight through reporting, define reports, various revenues. So this is the whole process itself, and you have to be able to know all of these points here. You have to be able to understand what is your oversight over all of this. And I would actually, you could actually go through and just say, create a good management kind of a document, management oversight, and say this is how we control this from an IT perspective. This is how we gain comfort that all of these processes. It doesn't have to be fancy. You don't have to write a 10-page dissertation about this, but you can actually go through and just say, well, this is how we manage our access, this is how we manage our IT, and this is how we come comfort with this overall process and how we're applying this standard effectively, and we have confidence our system is operating effectively. So we can see how all of these things kind of interrelate. So, kind of in conclusion, we have these standard IT general controls. We need to apply them, but, they need to be very precise. We talked about this, in one of the footnotes, and earlier we were talking about this level of precision. We talked about populations. We have to make sure that we can identify all this stuff. We have to be we have to understand the level of precision that, how do you know that, the IT controls are being, applied appropriately. You want to make sure you have integrity over this. You ensure your change management and your SLC processes are operating correctly, and you have the data to back up through UAT approval makers, and understand the exception process. I really think that's going to be the key, because this is new. You're going to have more exceptions than exceptions to the process, and you're going to have to understand how do you adapt to that. That's going to be where all the work is. That's pretty much it. Any other questions?
All right, I'm leaving it open for only a minute on questions, and Larry, you did a fantastic job. It's a good overview. I mean, when people talk about IT and some of those considerations from a control perspective when you're dealing with the new revenue recognition standards, I'm really grateful that you put this overview together, especially that tie-in to those 5 steps of the transition into revenue recognition of the new standards. So I haven't seen that done before, and I'm really grateful that you did that for us today. We don't have any other questions, Larry, so I'm going to mute you so we can get into.
Thank
Yeah, thank you, Larry. Fantastic job. I'm going to mute you until we wait till the end, and then I'm going to add in my wonderful colleague and friend, Louis, and then I'm going to do a quick intro, Louis, for you. Unmute. All right. Okay, ladies and gentlemen, we're going to switch gears into the techie debits and credit side of the adoption of the new RevRec standards. Now, Louis has been actually a very big author on some technical accounting packages. If you've heard of companies like Thomson Reuters, etc., CCH, etc., Louis has had a hand in it, okay? So he's probably one of the more technical folks out there in the marketplace talking about the revenue recognition standards along with equity type transactions, etc. In addition, he was a partner over at PwC for a number of years, again, on the technical side. So we're really grateful for having Louis with us today for this live webinar. Louis, do you want to take the controls and kind of elaborate on what I just said?
You did a good job, Sonia. So why don't I go ahead and get started? Yeah, I'm a advisor on GAAP and financial reporting issues. And kind of the bread and butter of what I do is I consult on very complex transactions where an entity doesn't have the resources inside. Or I also consult on adoption of new standards, such as this new revenue recognition standard. So hopefully by the end of this presentation, you'll have a better understanding of the new standard, and I can give you some suggestions on how to make a smooth transition. Okay, so let's start with an overview of the new revenue recognition model. The new standard, which is also known as ASC 606, as Sonia said, it's the actual bread and butter of it is 150 pages long, which, not including all the basis of conclusions information, that still makes it one of the largest, if not the largest, standard put out by the FASB. It replaces all of the guidance that's currently out there and all of the industry-specific guidance with a couple of exceptions, but most of it anyway. And it changes focus in that rather than the current rules that cover completion of the earnings process and transfer of risks and rewards of ownership, the focus of the new standard is on performance obligation and satisfaction of those performance obligations. It also focuses very significantly on transactions known as performance obligations filled over time, which are service transactions. The standard also requires certain costs to be capitalized, such as incremental costs of obtaining a contract and costs to fulfill a contract. The standard is largely principles-based as opposed to the current standard, which we call rules-based. So there aren't a lot of bright lines in there, and applying it will require a lot of judgment and estimates, and it'll also require an entity to collect a lot of data to support those judgments and conclusions. Since it is very principles-based, documentation of judgments is going to be very important. So what's the core principle of the new model? And this is basically a quote. An entity should be recognized revenue to depict the transfer of control of promised goods or services via contracts with customers at either a point in time or overtime at the amount that reflects the consideration to which the entity expects to be entitled, including variable consideration, in exchange for those goods and services. So that's the overall intent of the standard. In order to apply that, here's the old 5-step model, which I think we've covered twice now, but it's worth going through again. Step 1 again is identifying contracts with the customer. 2 is to identify separate performance obligations in that contract. Step 3 is to determine the overall transaction price for the total transaction. Then, once you do that, you have to allocate that transaction price among all the separate performance obligations identified in Step 2. And finally, you recognize revenue as a performance obligation is satisfied. So let's start with Step 1, which is identifying the contract with the customer. A contract is an agreement between 2 or more parties that creates an enforceable rights and obligations. Also, it has to meet 5 criteria. There must be approval and commitment between the parties. The contract must identify all the rights of each of the parties. The contract must also identify the payment terms. It must be probable that the entity will collect the consideration it's entitled to. And the contract must have commercial substance. In some cases, the entity will be required to combine 2 or more contracts, but we won't get into those details. The collectability assessment needs to be performed only at the outset of the contract unless there's a significant deterioration in the customer's ability to pay. And when an arrangement doesn't meet all of the 5 criteria to be considered a contract, no revenue can be recognized at all on that contract until the 5 criteria are met. Okay, so what are some of the expected impacts of this Step 1? Well, it needs to be noted that the new standard doesn't require 2 signatures on a contract. What the standard is whether the contract is legally enforceable. That could be a written contract, it could be an oral contract, or it could just be implied by an entity's customary business practices. Therefore, whether or not a contract is established may require legal team involvement to document the specific point in time when a contract becomes enforceable. And those policies and practices for establishing contracts can vary across legal jurisdictions, industries, and entities. So if a company uses non-standard contracts, this may be even more of a challenge for that company. The standard does allow entities to perform the assessment to a portfolio of similar contracts, but there must be processes and controls to identify outliers to that portfolio. As a result, entities might want to standardize their contracts or formalize customary business practices to better document the point in time that the 5 contract criteria are met. Okay, so now we'll discuss Step 2, which is identification of separate performance obligations in the contract. A performance obligation is a promise in a contract with the customer to transfer to the customer either a good or service, or a bundle of goods or services that are distinct, or a series of distinct goods or services that are substantially the same and have the same pattern of transfer to the customer. So, performance obligations must be assessed at the inception of the contract, and they could be either implicitly stated in the contract, or they could be implicit if there's a valid expectation the customer will provide a good or service based on the seller's customary business practices, published policies, or specific statements. So when is a good or service distinct? Good or service is distinct if both of these criteria are met. First, the customer can benefit from the good or service either on its own or together with other resources that are readily available to the customer. In other words, This is known in the standard as a good or service being capable of being distinct. Now, a readily available resource is a good or service that is sold separately by the entity or another entity, or that the customer has already obtained from the entity. The second criteria is the entity's promise to transfer the good or service to the customer is separately identifiable from other promises in the contract, also known as distinct within the context of the contract. A good or service that isn't distinct needs to be combined with other promised goods or services until the seller identifies a bundle of goods or services that are distinct. So what are kind of the expected impacts or takeaways from step 2? Well, although not in all cases, the number of separate performance obligations identified may increase as compared to the separate elements identified under current GAAP. And that may, as Sonia mentioned, cause some acceleration of revenue. When identifying the promises in an arrangement, it's important to carefully understand the entity's policies and practices, representations during contract negotiations, its marketing materials, and roadmaps and business strategies. As those may not remain static over time, an entity has to identify, document, and track the ongoing impact of changes to its materials, roadmaps, etc. Think about that. That could be a little bit of a task. Performance obligations may be identified using a portfolio approach, similar to contracts, but the entity may have to identify, may have to have a process to identify outliers that don't fit into that portfolio. Also, if non-standard contracts are used, or if a different mix of performance obligations are used from one transaction to the next, the entity may have to identify distinct goods or services on an individual contract-by-contract basis. And again, the entity may want to consider making contractual changes to make it clear when goods or services are distinct within the context of the contract. So I'm going to go through step 3, which is determining the transaction price. Well, the transaction price is the amount of consideration, i.e. the payment, to which the seller expects to be entitled in exchange for transferring promised goods or services to a customer. Now, the transaction price is, excuse me, I didn't flip the slide here. The transaction price is affected by an estimate of variable consideration. It may also be affected by the existence of a significant financing component. In other words, the concept of time value of money. Also, non-cash consideration and consideration that's payable to a customer. Now, let's talk about variable consideration. If a contract includes variable consideration, an entity must estimate it. Variable consideration can be either explicit or implicit. It's implicit if the customer has a valid expectation arising from the seller's customary business practices, published policies, or specific statements that the seller will accept a lower amount of consideration, or if other facts and circumstances indicate that the seller's intention at the outset is to offer a price concession. There are various types of variable consideration, such as bonuses, refunds, rights of return, credits, incentive payments, money-back guarantees, price concessions, performance bonuses, penalties, volume discounts, volume rebates, and royalties. And that's not necessarily an all-inclusive list. There are basically two ways to estimate variable consideration, which are, depending on which method better predicts the amount of consideration that the entity is entitled. Those are the expected value method and the most likely amount method. The expected value method is taking the sum of the probability weighted amounts in a range of possible outcomes. That method is most predictive when the transaction has a large number of possible outcomes and the entity has a large number of contracts with similar characteristics. However, it can also be based on a more limited number of discrete outcomes and possibilities. The second method, most likely amount, is taking the single most likely amount in a range of possible consideration amounts. That is, the amount, it may be most appropriate when there are two possible outcomes, such as a bonus will either be made or not made. Now, variable consideration should be estimated using the method that better predicts the amount which the entity is entitled to based on its facts and circumstances. And once the method is selected, it should be applied consistently throughout the contract and for similar contracts. Now, there's a constraint on the amount of variable consideration that an entity can record. An entity can include variable consideration only to the extent that it's probable that a significant reversal of the cumulative revenue recognized will not occur when the uncertainty associated with the variable consideration is subsequently resolved. Now, this is different than the concept of materiality. This is whether there would be a significant potential reversal of the revenue on a contract that's been recognized to date. At each reporting period, the estimate of variable consideration should be updated, and any difference in estimate of the probable amount needs to be recorded as a cumulative catch-up adjustment. So what's the expected impact in the area of variable consideration? Well, the fact that even recording variable consideration might significantly affect the timing of revenue recognition as compared to current GAAP. There are different ways of treating variable consideration all over the place in current GAAP. So this may be a big change. When variable consideration is estimated, it's going to require significant judgment about the amount that should be included in the transaction price. However, as similar to the other areas, it may be determined by class of customer, products or services, distribution channel, etc. If it's expected to provide the same result as if it were estimated on a contract-by-contract basis. However, again, the entity will have to have processes and controls to identify outliers that don't fit into that classification. So an entity must carefully identify and document its customary business practices, published policies, specific statements, and her intent to offer price concessions that may cause consideration in a contract to vary. These will need to be tracked over time to incorporate any changes to those practices, policies, etc. Okay, now let's talk about step 4, which is allocating the transaction price to each identified performance obligation. Once a performance obligation is and transaction price have been determined, an entity needs to allocate to each performance obligation the amount of consideration which the entity expects to be entitled in exchange for satisfying each performance obligation. Now, how's this done? The transaction price should be allocated based on the relative standalone selling price, if that's available, which is the price the entity sells the good or service separately. Of course, the best evidence of that is when an entity sells that good or service in similar circumstances to similar customers. The contractually stated price or list price, it may be, but it's not always presumed to be the standalone price for the good or service. Now, the standard contains certain specific guidance on allocating discounts and variable consideration to or among individual performance obligations. So, if the standalone selling price isn't directly observable, i.e. the company doesn't sell the good or service separately, then an entity must estimate the standalone selling price. The objective in estimating it is to arrive at an amount that a customer would that would result in the allocation of the transaction price that the entity expects to be entitled to. If one of three approaches need to be used to estimate the selling price. You have the adjusted market assessment approach, the expected cost plus margin approach, and the residual approach. Under the adjusted market approach, you take competitors' prices and adjust them to reflect the seller's costs and margin. Under the expected cost plus margin approach, an entity forecasts expected costs and adds an appropriate margin. The residual approach is only to be used if the estimates in standalone selling price are highly variable or uncertain. Under that approach, the entity estimates the standalone selling price by taking the total transaction price less the sum of observable standalone selling prices of other goods or services promised in the contract. Now, all these methods of estimating the standalone selling price need to take into account entity-specific factors, information about the customer and class of customer, and market conditions. And similar to estimating fair value, a entity must maximize the use of observable inputs and must apply this method consistently in similar circumstances. Sonia, maybe this is a good time for the question.
Yeah, I think this is a great opportunity because there was a couple of things that I picked up on in terms of themes of what we're talking about. One of which is anomalies or outliers, right? Those aspects where if you do not really feel you have a homogeneous pool of revenue line items, or better yet, you have a revenue line item with multiple arrangements, having good controls about identifying anomalies within the standard contracts, it just seems like it's a must-have for companies to have a process in place whenever to identify those anomalies. We don't have any other questions per se, but I also noticed something else as a theme really so far is new product development or new service lines that you're trying to validate. So you don't have, let's say, customers in queue, or you think you may have customers in queue. And marketing and salespeople are a very interesting breed in the sense that they really are optimists, and they think that for a certain type of contract price they can sell it. But reality inevitably sets in, and looking at your competitors and then building in a margin, I was just taking a look at that and I thought, oh my God, that's going to be really complicated because you're reverse engineer, you're taking someone's standard and then reversing it out to your own cost structure and putting in the appropriate margins. It just seems like you're really looking at a lot of public company information to kind of extrapolate that. And even then, some public companies don't give out too much information in terms of, especially if it's a new service line that's being offered in the marketplace. So very complicated things. No questions so far, but obviously there's this transaction price allocating model that you have here. I can see the inputs are going to be the point of focus for auditors to really find out, well, how is management checking the level of precision and accuracy and completeness for all of these areas?
Yes, and just think about the auditors wanting to get your documentation of what your competitors' prices are and how you're adjusting either the costs or the margins. If you think about that, you know that it's really important to have this database of information and to be able to justify it. Okay, do we have a polling question that we need to do, or should we do that a little bit later?
Now, oh,
Okay, well, why don't
yeah,
I
we're good to go.
why don't I move on? Okay, why don't I move on? Okay, so what's the expected impact of this whole area of allocating the the transaction price? Well, determining the price may require significant judgment. If performance obligations, discounts, or variable consideration vary from one transaction to the next, then allocation of the transaction price may need to be performed on a contract-by-contract basis. The requirement to estimate and allocate standalone selling price would have a particular impact on software companies, since vendor-specific objective evidence of fair value is no longer required for software companies in order to recognize revenue for a deliverable. In situations where revenue is currently deferred for software companies, that revenue may be accelerated. And allocating transaction price based on the relative standalone selling prices may necessitate significant modifications to the information systems currently in use. Okay, let's move on to the next area is when to record revenue. Revenue is recorded when a performance obligation is satisfied, which is when or as the entity transfers a promised good or service to a customer. The good or service is transferred as the customer obtains control of the good or service. So control is the operative term. At the inception of a contract, an entity must determine whether each performance obligation is transferred over time or at a point in time. Now it's interesting, the standard doesn't define when an obligation is transferred at a point in time, as the focus currently is in existing GAAP. But due to the new focus on service transactions, the standard defines when performance obligation is transferred over time. And if a transaction doesn't meet the criteria for being transferred over time, then it's considered to be transferred at a point in time. A good or service is transferred over time if any of three criteria are met in no particular order. Either the entity creates or enhances an asset that the customer controls as it's created or enhanced, for example, work in process, or the entity's performance doesn't create an asset with an alternative use to the entity. That is, the entity can't sell it to another customer, and the entity has an enforceable right to payment for the performance completed to date. Or the customer is receiving and consuming the benefits of the entity's performance as the entity performs, and another entity would not need to subsequently reperform the work the entity has already completed to date if that other entity were to fulfill the remaining performance to date. A good example of that would be a cleaning or janitorial service. If none of those three criteria are met, if any of those three criteria are met, then control of goods or services are transferred over time. And if none of them are met, the control of goods and services are transferred at a point in time. So performance obligations satisfied at a point in time, revenue would be recognized when the seller transfers control, and indicators of that transfer of control include the seller has a present right to payment, the customer has legal title, the customer has physical possession, the seller has right to non-refundable payment, the customer has the significant risks and rewards of ownership, or the customer has accepted the asset. And again, this is not an all-inclusive list, and you could see it's much more broad than transfer of title and transfer of risks and rewards. For performance obligations transferred over time, progress toward transfer of control is measured by two different methods. This is similar to current contract accounting, either an output method such as hourly billings or milestones, or an input method such as costs, labor hours, or time. So what's the expected impact? Well, the concept of transfer of control, it may require careful consideration and judgment. It may also change revenue timing because there's no longer a narrow focus on transfer of risks and rewards of ownership. Again, determining when control was transferred may involve legal considerations that vary across jurisdictions, or performance obligations, distribution channels, etc. The transfer of control concept may change revenue recognition patterns for companies who currently use sell-through accounting for their sales through distribution channels. And the new guidance on service transactions may be a significant change to entities outside the construction or contracting industry who currently use various methods within GAAP to recognize service revenues. Okay, now we're going to talk somewhat about disclosures. I'll give you a high-level overview. This is what the FASB says is the objective: to provide sufficient information to enable users of financial statements to understand the nature, amount, timing, and uncertainty of revenue and cash flows arising from contracts with customers. The standard requires numerous qualitative and quantitative disclosures. The disclosures are required for each period in which an income statement and balance sheet are presented. I'm going to go through this kind of quickly, but you can see some of the examples of qualitative disclosures. Obviously, significant judgments and changes in judgments, methods used to recognize revenue for performance obligations satisfied over time, etc. If those aren't enough for you, the quantitative disclosures are scary. You must disclose the amount of transaction price allocated to the remaining performance obligations, revenue disaggregated into categories, assets recognized from cost to obtain or fulfill the contract, etc. Now, the disaggregated revenues is in particular kind of scary. The principle is to disaggregate revenue into categories that depict the nature, amount, and timing and uncertainty of revenues, how that's affected by economic factors. The company should base the categories on its entity-specific facts and circumstances. Example categories include, for example, type of good or service, geographical region, market or type of customer, type of contract, contract duration, timing of transfer of goods or services, or sales channels. Judgment is required regarding the level of aggregation or disaggregation well in advance of the adoption. And the categorization may necessitate changes in information systems. Just think about all these different potential types of categories, which are to be based on not only what the customer or the entity uses to categorize its revenues, for example, segment reporting, or what the chief operating decision maker reviews, but it also needs to reflect the information that users of the financial statements rely on in order to understand the performance of the entity.
Hey, Louis, I wanted to ask a quick question to the group here, a polling question about merging or acquiring new entities. I'm going to open the poll up because it ties in obviously on some of this items in terms of sources of revenue. How many of you are either going to be merging or acquiring new companies in the next 12 months? So I'm putting it into the context of the next 12 months. And it's yes, no, I wish, but we have no money. I don't know. So for those of you who are interested in CPE, please answer the question. How many of you are merging or acquiring a new company in the next 12 months? It ties into a lot of the points here that Louis is presenting for this disclosure requirement. And Louis, we would love to get your thoughts about best practices when you do have to adopt the revenue recognition standards, what you think the marketplace should be doing at a point in time, or should they be doing obviously modified type of disclosures, and if so, what that would look like. So let me close the poll out and end it here. So about 26% of you said yes, you are. 42 said no. 10% about wish that they had the money to do so, and 21% don't know if they're actually going to be doing any acquisitions or mergers of new companies. So, Louis, give us your thoughts when it does happen and you have to implement the new standard. Any best practice items people should take away in terms of the adoption process of this new RevRec standard when they buy or merge with another entity?
Well, Sonia, there's similarities. Earlier we talked about looking at future product offerings or changes to product offerings. And the concept is similar with acquiring new companies. An entity needs to stay ahead of the curve and understand what changes are going to have to take place in order to integrate the company into its information systems, how the revenue will be recognized according to its own policies, but also they need to understand what how the company being acquired recognizes revenue, what are their stated and unstated promises to customers, customary business practices, etc., and try to move to really merging those with the company's own policies. But a company can really be caught off guard when coming out with a new product offering if it doesn't think about the impact on the revenue recognition before it gets into those new transactions.
And I agree with staying a step ahead. And also, when you merge with another company, when you have, let's say, it's a like kind situation, or at least you perceive it, you're still supposed to take an inventory of those groups of contracts and then try to find if your basis of what is truly an anomaly or an outlier in your current position. When you do merge that entity, you have to look at both populations together in the same format to find out whether or not you had other types of anomalies.
Exactly. So I'm going to go through some examples of potential categories of disaggregated revenues. This may not apply in the same format for everybody because it's based on a company's particular facts and circumstances. But here's one showing primary geographic markets and by product segment. This is what it would look like by major goods and services by product segments. This is by geographic region and sales channels. And this is the timing of revenue recognition by product segment. So you can see there's various ways that the information may need to be presented. So some of the takeaways on the disclosures, significant management judgment is going to be required to determine the disaggregated revenue disclosure categories. And the categories may go beyond what's currently being used for segment reporting. And if you think about those disaggregated disclosures, your information systems may not be able to produce those categories at the current time. So the company needs to really look at the information systems. Also, the process of disaggregating revenue may cause companies to rethink its segment reporting categories. And internal and external information that was considered in determining the categories will need to be well supported and documented. Again, think about those auditors. So now we're going to talk briefly about the effective date and transition methods. This slide kind of encapsulates all of it. This reflects the The FASB recently exposed for public comment a delay of 1 year of the effective date, which we should find out about soon, whether that's been approved. But it's expected it'll be approved. So already reflecting that change, the standard will become effective January 1, 2018. And that's for all companies. I'm sorry, that's for public companies. Now, as Sonia mentioned, there's two ways to adopt the standard or transition. One is the full retrospective method, and under that method you could see that the income statement is restated for all periods presented. So for calendar year public companies, that would be going back to starting in 2016, which is next year. And in order to start collecting that new information starting next year, the company is going to have to basically have dual record keeping during 2016 and 2017. Now, the second method is the modified retrospective method, which means that a company would only convert to the new GAAP in the year of adoption, which would be 2018. And old GAAP would be used for the 2 prior years. But if that method is used, then there's different disclosures that are required in the year of adoption. And that necessitates dual record keeping in 2018. Now, think of public companies. Think about they basically have just 1 more year than the private companies. So here are some overall takeaways that I want to leave you with. Okay, the transition choice has a big effect on systems, processes, and controls. So the decision as to which method will be adopted should be made as soon as possible. Critical decisions and judgments required throughout the standard necessitate careful and possibly time-consuming consideration and documentation. Changes to the information systems may be required to compile and document historical data and to keep that data up to date. Determining and documenting the entity's customary business practices could be a lot of work. The new standard will significantly affect internal controls and SOX compliance. An entity will need management, audit committee, and auditor buy-in, which should not be left up to the last minute. There is a potential need for contractual changes, for example, revenue contracts, compensation structures, loan covenants, and maybe even others. Information systems or manual processes will also likely need to be changed. Training and preparation will be needed throughout the organization, and the implementation will affect multiple departments, functions, and geographic regions of a company. So who's impacted by this standard? Well, this is a busy slide. I'll let you look at it for a second here. But basically, you'll see not only do the controller and CFO have to make judgments and manage the project, but general counsel may be involved, the CIO may be involved, sales and marketing will need to be trained, incentive compensation structures may need to be trained. Training will be needed throughout the organization, CEO, audit committee, board of directors, and finally, lenders and analysts will need to understand the impact of the new standard. So what could go wrong? Well, a company may run out of time to do an acceptable job, so last-minute errors will become more likely. Internal controls may not cover the necessary periods for which historical data is collected. A company may run out of time to assess and test the internal controls. Therefore, a company may get stuck in the auditor's last-minute crunch because, let's face it, a lot of entities may wait till the last minute to begin transitioning to the new standard. As a result, the auditor service may not be as timely, or an auditor may just not have enough time. There may be no time for auditor feedback to allow an entity adequate time to correct any problems, and then audit fees may balloon. Another risk is that the company may not have adequate time to implement changes to information systems, select and implement new systems. Selecting and implementation of new systems is time consuming. A company may change its mind on the implementation method, but it may be too late in the process. There may be a failure to take a cross-functional departmental approach, which may cause last-minute organizational upheavals and unintended consequences. A company may not have considered the impact to new product offerings or business practices ahead of time, and there may not be adequate time to make necessary contractual changes. So what are my recommendations? First of all, start making critical judgments and define the revenue recognition model to be applied by class of arrangements with customers. Analyze gaps in the IT systems, processes, and controls. Anticipate what the pervasive organizational impacts and include affected departments and disciplines in the transition effort. Provide training to affected parts of the organization. Examine both the current and future product and service offerings under current and future GAAP. Critically evaluate the two transition approaches, the benefits and downsides of each. Determine and implement the appropriate internal controls over financial reporting. Assess whether external resources are needed to help with the transition. And finally, don't underestimate or delay the implementation effort. I know that companies are thinking, well, I just got a one-year reprieve, but I can't emphasize that anymore. So, Sonia, that's there's time for questions.
There's a lot of takeaways here, and we'll open it up to final questions and comments. So I wanted to do a quick plug again for those of you who joined us on this live webinar. You should be a COSO implementation member. This is the logo. It's in LinkedIn. Slides will be available. It's usually through SlideShare. So please don't email me for the slide deck. You can get it yourself in about a week. Go to slideshare.net. And here's the LinkedIn group for the COSO implementation in terms of CPE credit. For those who are members, you get the CPE certificate. And I also wanted just to reiterate, there's 2 spots on that control compliance analysis. I know one of them's already been taken. I don't know if CISA told me the other one's taken too. So just as a quick reminder, info@avivaspectrum.com. CCA reservation would be the subject line, or just the CCA itself is fine, just so CISA and I aren't digging through a ton of emails. Lastly, we are hiring. I'm looking for the elusive unicorn. It's called the Senior Internal Auditor. So for those people who know really great audit staff or IT auditors, we're also looking for SEC reporting managers for certain clients that have hired us to do some recruiting, and cybersecurity consultants. So careers@avivaspectrum.com would be a great quick email for you to send. And then last but not least, our contact information is available here. Louis' phone number is a little blanked out here, but are there any questions from the audience as we wrap up the Revenue Recognition Internal Control Considerations webinar today? And I want to thank Larry and Louis for their participation. You guys did a fabulous job in covering some major critical items. So questions to our panel here. Go to the Q&A section if you guys are interested in any questions. There's a few, let me see, probably again. I don't see any.
Sonia, I
Okay.
want to just mention one thing. If anyone just wants to bounce a more specific question off of me, feel free to send the question along to the information email address, and I'd be happy to address it for you. Or if you just like to talk about your company's implementation, I'll give you a complimentary evaluation.
Okay, fantastic. And Louis' email is lpuncel at puncelconsulting.com. Thank you, everybody, for being with us on this wonderful Tuesday late morning. And if there's any other follow-up questions, you can obviously ping us later as well. Thank you.